Okay, welcome to First Draft Live. It's Friday, August 8th. I'm Mark Bonner, Business Editor-in-Chief, coming to you live from New York. Thank you to so many of you for tuning in across the country and around the world. We really appreciate it. Today, opportunity zones are back, and the game has changed. Launched in 2018, as we all know, OZ's pulled in over $100 billion of investment from coast to coast. And it also lit up debates about gentrification, political favoritism, and whether the money ever reached the places it was supposed to go. But it also sparked thousands of new projects coast to coast, from apartment towers in downtown Los Angeles to manufacturing hubs all across the Midwest. And it also became one of the largest housing incentives in the country, funding roughly half of all new housing starts in these designated zones over the last 5 years. Now, under the One Big Beautiful Bill, OZs are permanent. The map will get drawn every 10 years. The rules are tighter. Rural America will get juicier incentives. But before it all kicks in, CRE will face an 18-month dead zone where deals are feared to stall out. A brand new set of U.S. governors will decide the next map in 2026. And with politics in play, the stakes couldn't be higher. Our guest, Steve Glickman, CEO of Statt and one of the original architects of the OZ program, call him the Wizard of OZ. He's here to break down what's really changing, who's poised to win, and how investors should be rethinking OZs, especially as they get into 2.0. We'll also be hitting some hard questions. Will rural America finally see the capital it was promised? Do the new guardrails actually bite? And how does this reshape the CRE playbook? Send your questions in the chat now. We're going to go AMA style a little bit later in the program. But Steve, welcome to the show. Thanks for being here.
Thanks, Mark. Great to be here. And I think it was, I mentioned previously, I'm a huge fan of BizNow and grateful for how consistently you guys have covered this program over the many years. So excited to talk with you today.
It's our honor. Thank you, Steve. We appreciate it. So look, let's just jump right on in. Steve, intro had a lot of information. There's a lot of things that are changing. In your opinion, especially as the person who helped to draft this original Opportunity Zone program all those years ago, what do you think is the single most important change that investors need to understand right now?
Well, I think you highlighted one of the most important things just in your intro, which is when the program was started in 2017, 2018, it was really an experiment in this new form of economic development in private investment in low-income places. And at the time, we had no idea whether the program would be successful in generating the amount of capital we hoped it would generate, and we didn't know whether it would be reauthorized or, if ever made permanent. So the permanence of it is critically important because it creates a certain reliability for both investors and funds and developers and communities that this is something they can channel capital into, build infrastructure and funds around, build strategies around. So I think that's definitely number one. I think it's worth noting not much has changed about the program in terms of the way it functions day to day for either investors or developers. But there are a couple other things that are, I think, worth knowing. The first is that there's going to be a whole new set of zones. I know we'll talk about that. So that will change the sort of communities that can benefit from the program and also where investors can invest. Two, the initial benefits that were tied to this program, the ability to defer your capital gains that you reinvest in opportunity zone funds and to get a 10% step up or discount on that tax bill, that's going to be now a 5-year cycle. So no matter when you invest, 5 years later, you'll get the benefit. That's a big change because I know we'll talk about this perceived quote unquote dead zone of investment that should prevent that from moving forward. And, and we'll talk about this as well. There's also some new benefits for rural investing, and that may change where and the types of communities in which people invest.
Yeah, the first time around, there was great interest in where all this was going to go. And then as it unfurled, we got 8,700 tracks across the United States. This new set, we don't know, and we're not going to know until next year. That's because that 10-year OZ map will be drawn by a different set of governors after the 2026 elections. And 1.0, as you discussed, Many leaders underestimated the program's reach. They didn't know what it was. It took a little bit while for the train to get on the rails here, and then it turbocharged in investment. This time, no one can claim ignorance, right? Local coalitions around the US are already mobilizing to lobby for inclusion. Steve, how do you see this playing out?
Well, I mean, from the substantive perspective, in terms of the types of communities that will be selected, there are going to be some big changes there. I mean, you're going to see a different map for a few different reasons. And, parenthetically, I think that's a good thing. That was the design of the program because the economy's changed over the last several years. So there are going to be lots of zones that just simply don't qualify. And the new version of the program, the criteria for being in a low-income community that can be an opportunity zone designation has strengthened or shrunk so that you have to have 70% of the median income to qualify. So you're just going to have a smaller map overall. Two, there's going to be politics this go around much more so than the first go around. The governors, back in 2018 had to pick zones really quickly in order to avoid the sort of lobbying we expected might play out. No way you're going to avoid it this year. And it's going to happen in an election year for many governors where I expect opportunity zones to be a part of that political discussion. But functionally, or sort of the process of how it will be selected, I'm not sure it's going to work that much differently. And there's a couple of reasons for that. In most states, you saw governors appeal to communities and cities to nominate zones, both because they're closer to where there's investable activity, but also because it diffused some of that political accountability for investment in communities. So the more you're sharing in it, the better information you have between governors and mayors and county leaders and community developers, and better information you're getting, and the more you're diffusing that kind of political challenge. So I think the process may look very similar, but the types of zones selected may be quite different moving forward.
Look, as you know, the political turmoil in the country has probably never been stronger, at least in a generation. I mean, do you think that these decisions will be factored in by red state versus blue state, red district by blue district? Like, does this favor either of the political parties at this moment? Do you think that's going to make a difference here?
No, I mean, I don't think so. There's obviously some more incentives for rural communities. Rural communities have tended to correspond with more Republican-leaning states, and you're certainly going to see a difference in makeup. I would expect to see more rural communities in places like, the Southeast, as opposed to places in the Northeast or the West. But every state's got a mixture of constituencies and communities that are urban and rural. And I think you're gonna see a pretty healthy mix of zones, and there's gonna be a tons of different communities watching this and using it to evaluate their own, voting decisions going into 2028. So, going into 2028. So, I don't see this favoring one party over another. I just think in different regions of the country, you might see a different makeup or focus on where those zones are.
Population migration has been a huge story the last half decade since the pandemic, right? We're aware of the Sun Belt, the Deep South, how much that's grown. We're aware that the Northeast and some of the major urban cores have lost population. Is this OZ program and this new map going to follow that, or is it going to go to places that are the next new thing? And if so, like, where do you think on the map that we're going to see the most movement in terms of how these new tracks are formed?
Well, I can tell you what I think is the smartest way to think about zone selection. And it's not to pick the zones that are necessarily the most needy for investment, or could benefit the most from it, because as a program that's driven through private sector capital channels, you need to make sure there's both a strategy and assets that are investable for outside private investors to make that worthwhile. You could pick a zone and it may get no capital. That didn't happen in too many zones this last go around. Almost all of the zones selected got some form of capital. But certainly you saw less capital in places that weren't as investable. And so there's this nexus between economic need and investability, I think, is a really important matrix to get right. And the places that did it the best last go around, I think did two or three things. One, they really did get that bottoms up view on what projects and communities and plans were the most interesting and for this program. Two, they had a real strategy
Hmm.
for it, and three, they did it in a way that was pretty public and transparent, so you had buy-in from the get-go from both those community leaders and the investors. That should be easy for every state to accomplish, and if they can do that, I think you'll get the right mix of zones. But that's the right way to think about zone selection, is that nexus in where the private sector is willing to invest and where the state has certain economic or community development priorities.
Okay, before we move off the map, I just want to go to a question from the audience. What year of AMI data will be used for the 2026 zones? Do you know, Steve?
It's a good question. Yeah, I don't think we know yet. And although it will be different data than obviously last go around, the next American Community Survey is finalized at the end of this year, and that was the most important data source last go around. So I expect Treasury to use that as the data source. But keep in mind, and we may talk about this a bit. In the first go around after OZs were created in law in 2017, there was a 2-year period of writing regulations that really became the guidelines for how to organize and invest in and form funds in and build assets in this program. You're not going to see nearly as much work this go around because, again, the rules haven't changed significantly. But some of those details around economic data, around how zones ought to be selected by governors, around what will happen with the transition between the old zones and the new zones, some of those details are just not in the legislation. And I think you can have a pretty informed view of what that might look like. But at the end of the day, we need to hear from Treasury and the IRS in their rulemaking, which is going to happen over the rest of this year and probably early next.
Let's talk about the much ballyhooed dead zone. The current OZ map expires at the end of 2026, but the new one doesn't take effect until January 2027. That's an 18-month window where investors can't be sure if their sites will still qualify. Some OZ funds, as you might know, Steve, are already delaying commitments until the redraw is settled. What's your view here?
So I think that premise is a slight misnomer. So let me take issue with it respectfully,
Sure.
of course, Mark. What has really happened in the program is something that was anticipated when the program started, which is that you would have some period of overlap between the selection of new zones and the qualification of old zones in this program. It was always anticipated you would select new zones roughly every 10 years or so to match up with the new economic data. What's happened with the legislation is that the existing zones have a few different dates tied to them that are worth disaggregating. Investors have until the end of 2026 to invest in Qualified Opportunity Zone Fund under version 1.0, let's call it, of the program. The zones themselves stay in force until 2020, the end of 2028 still. So that means the funds, once they get that capital, will still have a few years to deploy it into those 1.0 zones. And then they can hold those investments for up to 30 years. So those funds don't, go away once those zones go away. They're just responsible for managing and navigating those investments, and they can, hold it up to that 30-year period of time. And then in 2027, that's when you can deploy new capital gains into the 2.0 version of the program. What that functionally means for investors, if you have capital gains you realize in 2025 or 2026, you're not going to have the option to hold on to them until 2027. You're going to have to invest them in 1.0 of the program. Now, you may not want to because some of the incentives are weaker now. You don't get a deferral. You don't get that 10% step up in basis. You would get those in 2027. But the reality is, because it's tied to realized capital gains, most investors don't have a choice on the timing when they realize it. A lot of the capital in this program comes from exits from companies or other projects or stock market investments where they want to take some of the gains off the table. And so if you want to use the program now, you have to invest now. And there are plenty of funds around the country that are continuing to solicit cash, continuing to raise capital. There's been billions invested in the first quarter of this year. It's slower
Right.
than the first few years of the program, but this idea of a dead zone, I don't think is particularly true. I think you're just facing the reality of a program where the initial incentive has gotten a little bit less attractive, and thus less investors are looking at it as strongly.
Well, this dead zone name, okay, it sounds scary. It's made for headlines, right? But let's just call it a gap, right? I mean, so you don't think this gap could trigger an early wave of exits or repositioning in current OZ portfolios?
I mean, it should. Remember, the biggest incentive of this program, if you're a rational investor or a fund, is that you're going to hold on to your OZ investment in this fund for at least 10 years. The only way you get forgiveness is if you hit that 10-year mark. If you've invested in the program at all, starting in 2018, although most investment came later in 2019, 2020, 21, 22. You got to hold it to 2029, 2030, 2031. If you exit now, you don't get that back end incentive. And the earlier you invested, the less likely you are to sell in this program, or it'd be silly to sell unless there was a real market reason to do so. So nothing has fundamentally changed for investors or funds in that way. I think it's great that you have a more valuable incentive going forward, and that the deferral and 10% step up is tied to when you invest, and you don't have this arbitrary deadline anymore. I think that's a great thing for investors starting in 2027. But it should change the dynamics of investing now. The most of the value of this incentive is tied for holding 10 years in the zone. There's still plenty of reasons for investors to invest. And if you're looking at doing a real estate project, investing in manufacturing or infrastructure or business that would qualify as an OZ investment, there's no reason not to do it now and wait till later, because for the most part, you probably can't. You probably either need to invest now because of the deal or because of the capital that has to go into that investment. So I think it's almost a silly view to have, although I understand why people have it, because I think there's a fair amount of headline conversation around no investments coming to the program next year. I just don't think that's what we're going to see.
Okay, if you're just tuning in, we're with Steve Glickman, one of the original architects of the Opportunity Zone program. We're talking about OZs 2.0. So send in your questions and we can get to them in the second half of the program. So, Steve, one of the original promises of Opportunity Zones was that it was going to revive rural and distressed communities coast to coast. But as we all know, most of the capital 1.0 flowed into urban core markets. Politicians doubled down on this promise to do better this time around, right? That revive rural America with rural incentives. Is there any reason to believe that the balance of investment will actually change this time around?
Um, so the short answer is yes, but let me unpack the question a little bit. The original vision of the program was to create a large and sustainable asset class that would tie a place-based investing in low-income places with where ordinary investors, private equity funds, developers, and others were looking to make their next investment. I think undoubtedly the program has achieved that. It's become one of the biggest, if not the biggest, community and economic development program on its books. You mentioned $100 billion of equity that's gone in just the first few years of the program. Really, that number should be much larger because so much of this investment went into things like real estate and infrastructure. You have a lot of debt married up to that equity, so you're probably talking more like $200 billion of investment, and all of that money has been put into low-income distressed communities. So by definition, you need to be a distressed community to get investment in this program. There's another question around rural communities, and rural communities in the U.S. make up about 20% of where people live. The best data I've seen show that about 10% of the program capital went into rural communities. So you're talking about 10 to $20 billion in rural communities. That's not as good as I'd hope the program would do because it's underrepresentative of our rural population in the U.S., but it's still 10 to $20 billion that arguably wouldn't have gone to those communities otherwise. In the new version of the program, there are new reasons to invest in rural zones by design. And let me talk about those incentives real quickly. If you're an investor going into a investment in a rural opportunity zone community, instead of that 10% step up in basis you'd get normally, you now get a 30% step up in basis. So that means you get a 30% discount on that tax bill, on that capital gains rollover. That's not insignificant. That's a 3x driver of urban markets. And the second is for funds themselves, instead of having to improve the assets you're investing in by 100%, doubling of the basis of existing assets, which is it's called the substantial improvement test and a core feature of the program. You only have to improve them by 50%. So the burden for funds is lower. I think that will mean more investment. And I think success would be, doubling the proportionally what you'll see in the program going forward from OZ 2.0 to 1.0. Hopefully, instead of 10% of markets, you're going to see 20% of markets, be rural communities, and that would be success. That'd be proportionate to what we're seeing in the country. You're still going to see the vast majority of these investments go into urban areas because that's just where investors invest and people live. And I don't think anyone should have a different expectation. This is a program that tracks the way investors are structuring their own investment decisions.
Yeah, I mean, look, as we know, I mean, upwards of 80% of all of OZ capital continues to flow into those urban cores, concentrated in multifamily logistics and data centers. I think that would surprise most people, though, who are not hardcore inside baseball, commercial real estate people. The rhetoric from politicians has made it seem like it would be stronger than that, right? Is this just simply people not understanding what the rhetoric means and how dollars are spent? Like, why is there this disconnect here, Steve? Because I think this is where the headlines come in when they start to dunk on the OZ program.
Well, listen, in some ways, it's for good reason, right? Rural communities in the US are some of the most economically disadvantaged and impoverished communities in the country. They lack a lot of the strengths that urban communities have in having a concentration of people and being homes to robust systems of post-secondary education and having and having the same type of economic vitality that urban communities have. So I do think we should be doing more across this country to invest in rural communities, which are the home of a lot of important parts of the economy, oftentimes manufacturing, infrastructure and energy production, farming and agriculture. I mean, the pieces of the economy that oftentimes the rest of the country takes for granted. Um, with that all being said, governors are going to play a big role in putting
Yeah.
their thumb on the scale of where they want to see investors go, and it's not just of where they pick the zones; it's also what other incentives and zoning and permitting and economic development dollars that they can put towards effectuating easier investment in rural communities. And it's going to take a kind of an all hands on deck, I think, effort here to push that forward. I think that'd be a great thing. But again, the data is what the data is. Most investment in this country goes to urban communities. Most investment in OZs go to urban communities. And that's not a bad thing. There are lots of worthy
Hmm.
distressed and low-income communities in urban areas that we should also want to see more capital going into.
OZ 1.0 OZ 1.0 had rules, but minimal reporting. OZ 2.0 mandates annual U.S. Treasury disclosures on investment dollars, jobs, and housing, allowing the public to actually track and trace where capital lands, right? Will that transparency strengthen OZs politically, or do you think it could potentially expose it to an uncomfortable truth about where the money goes, to your point earlier about most money flows to these urban cores upwards to 80%?
110% helpful. It's one of the biggest frustrations in this program. The first go around, for procedural reasons based on how the Senate passes bills on around reconciliation, the original reporting provisions were stripped out. It's critically important, not just for Treasury to get this information, but also for states so that they know where those investment dollars are going. And so communities are aware of where communities are, where funds are organizing and aggregating capital and the sort of investments they're putting in. And I think it's more data is better, and it's also sunshine is the best disinfectant. It's a great way to ward off some of the investments that we saw in the first round of the program, which weren't arguably in the spirit of where this program was going, and made people think twice before they invest in something that doesn't meet where the program is trying to deliver. I think that's less likely to happen anyhow this go around because of the new criteria in the program, strengthening the zones that can be selected to begin with, and raising the bar for economic need, and reducing the ability to put dollars in those border communities that might have been economically a little stronger to begin with. So a lot of those criteria had been removed between the first and the second round
Yeah.
of the program. But more data from my standpoint, you probably guess from our conversations, better, and we should want to have that data and have it be more transparent.
OZs now fund half of all new housing starts in these designated communities and represent 20% of new market rate apartments nationwide. From 2019 to 2024, OZ's areas produce 8.9% of all new residential addresses, which is almost double their projected share without the program. Look, we're in a housing crisis in this country, right? Is more supply the best tool for easing rents? And is OZ Capital doing enough and in the right places? Because the other criticism here, Steve, is that this is fuel gentrification.
So Thanks for asking that question. It's a really important one, and I think oftentimes a misunderstood one in connection with not just this program, but real estate development overall, at least from my perspective. So your numbers are right on. About half of that new housing starts in OZ communities came from OZ funds. It represented over 300,000 new housing units across the U.S. Importantly, those units cost the taxpayer about $20,000 a unit on average. So if you compare that to other types of low-income housing programs, where it might be more typical for a unit to cost 500,000 or $1 million per unit, you're talking about a bang for the buck that I would argue is unparalleled.
Mm-hmm.
And in the question of gentrification and displacement, I think every major study, from the Federal Reserve to the Urban Institute to everywhere in between, has shown really clearly that the more you build, the less pressure you put on pricing and the less displacement will occur in communities. And you can only do it in two ways. One, we should not want, which is that you weaken demand. That'd be terrible. That means that less people want to live in these communities. That's the opposite of what we should want for low-income places. And the only other thing you can do is increase supply. It's simple
Mm.
economics, supply and demand. There's a great, I think, recent example of it, that I just read about. In New Rochelle in New York, they've been building thousands and thousands of new units over the last few years. Price growth in New Rochelle is about 1.5% on rents. You compare that to New York City, where over the last few years rents have grown 25%. So building more, and we should be building more all over the country and unlocking new building through a number of things, not just OZs, but the amount of regulatory red tape we often put on building new housing should be our number one public policy goal as a country. And I think OZs obviously have shown they can contribute heavily to that in these communities.
Let's go to a question from the audience. So, for people in OZ 1.0 who are picking up their originally deferred gains on December 31st, 2026, can they roll those gains back into another OZ fund starting in 2027?
No. So in order to invest in the 2.0 version of the program, it's got to come from games that have been realized after January 1st, 2027. And that's the key, I think, argument that there's not going to be the dead zone people expect, or if to the extent there is, it's because people weren't aware that that was the case. If you want to invest capital gains that have been realized in 2025 or 2026, you have to invest it in version 1.0 in the program. If you want to invest in the 2.0 version of the program, it's going to come from gains that have been realized in 2027. And that's just the way the law's written.
Steve, if you're a developer or fund manager right now, what's the boldest OZ move you can make today that might not hold up over a 10-year map cycle?
Well, I think the boldest thing you could do, and the most interesting thing you can do, is one that will hold up over a next 10-year cycle. And that's to think, obviously, I'm a big proponent of multifamily housing and OZs, but there were other interesting things that happened in the tax bill that should enable a bigger diversity of asset classes. In particular, things like bonus depreciation, which, as I'm sure your viewers know, in the OZ
Yep.
program, there's no
Sure.
recapture on bonus depreciation. That should make asset classes like infrastructure and renewable energy and broadband and manufacturing a lot more attractive to investors because they get a huge additional boost. There's other parts of the tax code as well now around qualified production property and other things that make those investments more attractive. So, in thinking outside the box, and we're going to have a big need for data centers. We're going to have a big need for new sources of energy. Are I think really helpful. I for years sat on the board of a fund called Arcturus, which has an all asset class investment strategy all around the country. And again, I think thinking geographically diverse and asset class diverse is going to be an important part. I think also thinking about this along the lens of investments that are going to have a real impact on communities should be a part of everyone's calculus because of the transparency in this program. And I think communities are going to be looking to hear that more from investors to align with incentives they're going to be putting on the table as well.
So look, you're the wizard, okay? Is there one market, one asset class? Is there one political lever that everyone should be watching out for between now and July 2026? Put it on your crystal ball, Steve.
I mean, I think there's a couple things people should be doing to organize. One, regulations still haven't been written about this program. I think anyone who is going to be actively engaged in this should be engaged in that process actively. That means not just talking to members of Congress, but also talking to Treasury, talking to the IRS, and trying to being part of some of the important coalitions out there from the Economic Innovation Group and Novogradac and others that are trying to organize the smartest thinking around it. Two, talking with your governors and your mayors and your county execs to ensure that there's a map that makes sense and engaging early and educating them on how this program works. I think we need to be doing that in every state so that we align these zones that are selected with where investors are going to want to put dollars, and that's going to lead to the biggest impact in this, in this program overall. And then third thing I do is I just talk to investors. I think both fund
Mm-hmm.
managers and developers are going to know far more about this program than investment advisors or retail investors. I still think there's a lot of misinformation out there, and I think that's how we build the biggest collective program. In terms of assets, I think you're going to see more of the same. A lot of multifamily, and to me that's an exciting, important asset class. But I also think you'll see more infrastructure and asset-heavy industries come out of this program when you combine the OZ benefits with some of the other new benefits in the tax code.
Industrial data centers.
For sure. And those are great investments in rural communities where you're going to have that extra boost to put in extra dollars. You're going to want to go to places that have a lot of space to build and cheaper energy and being able to plug in both things like broadband infrastructure, but also manufacturing and data centers and industrial. I think will be huge, and it's been a really successful asset class overall the last few years. I would look at where overall trends are going. I don't think OZs will be any different. I think you're going to see lots of multifamily and industrial in the years ahead.
Okay, well, look, that's all the time we have for today. Steve, thanks so much for being here.
Yeah, thanks for having me. This was great.
Okay, we have some big news before we let you guys go. We're about to launch our brand new First Draft Insider Access newsletter, bringing you exclusive intelligence, early research report access, and market insights every weekday, written by me and Katie Dixon and Kayla Carmichael and Jay Ricky. Check it out. You can sign up through the link in the chat or at biznell.com under subscriptions, or email me directly, mark.bonner@biznell.com. I'd be happy to tell you all about it personally. Steve, email me. I'll tell you all about it.
I
We'll
will.
be back. We'll be back with another episode of First Draft Live next week. So don't miss out. You can sign up on our event page now. You can also find today's episode and all of our past conversations on your favorite podcast app. This is First Draft Live. Have a great weekend, y'all.